Hello, Oracles. Welcome back. Sorry I took last week off. Work has been wild lately. They just keep last minute asking me to go places. I was in New York the last couple of days. Um, Not the city, upstate. For those of you who have never been to New York, it's significantly different upstate than it is in the city. But yeah, so stock market's kind of been all over the place. Um, we'll go into the charts in a minute once everybody gets on here, and we'll take a look at what's going on. But we were Tesla's kind of following exactly what I had said. Just timing is a little bit off, but it's basically doing what I had predicted it was going to do, and then we'll just kind of see where it goes from here. And then the entire market itself is just kind of up and down and all over the place, and a lot of it's because one day Trump is like tariffs are on, the next day Trump says tariffs are off, and then he's against chips and going against China, and the market is reacting to all of this. And it's something we had known going into this, that because of the decisions that get made so willy-nilly, it's just going to end up causing the market to go up and down and go all over the place. So it's just, you got to roll with it. And again, the way I look at it is, nobody knows what's going to happen in the future. Nobody knows what happens tomorrow. So you dollar cost average, and that's really it. I just dollar cost average into it, and take it from there. And you dollar cost average, and you're going to get some lower prices and you get some higher prices. But historically, the market over the long term, and I'm talking 10, 15, 20 years, it's going up and to the right. So there was the lost decade from the dot-com bubble to the great financial crisis and shortly thereafter. But even after that, the market still went up, and actually went up significantly more for the 10 years after that, almost like it was making up for lost time. What's going on, Sith Lord? Hi, Colin. How you doing? So, that's one of those things where, again, there's the different mentalities, and my dad's more of a swing trader. So for him, this is a tougher market, but there's a lot more opportunity. Typically when you've got a market that is kind of a bull market going up and to the right, it could be easier for swing traders because you really can't lose. As long as you hold on long enough, you're going to make some profits on your stocks. And again, for me, like for my dad, retired, he doesn't have the income coming in, so he's not getting taxed heavily on those capital gains. For somebody like me, it's better if I am going to swing, if I hold on to it for minimum for a year, because then I'll get long-term capital gains, versus what ends up happening with my short-term, and I'm getting taxed as ordinary income. And then it's not even worth it for me to swing trade because of that, unless I'm doing it for more than a year. So that's why dividends come into play. And I'm waiting for my accountant to get back to me, because I did bring in about $6,000 worth of dividends last year, the majority of which were ordinary income. So I'm trying to just understand the math behind my own finances to figure out what I want to do for dividends, whether I want to cut back on those ordinary income dividends, put them into the more qualified dividend category, because then I'm not going to get taxed as much on them, and I can just let those grow slowly over time. Realistically, I have about a 5 to 10 year horizon that I'm looking at. I'd like to be able to retire in the next 5 to 10 years. And if nothing else, just kind of go to a part-time position at my job, just slow things down a little bit over the next 5 to 10 years. And so in the process of doing that, I have some time to let those qualified dividends grow, versus if I was just going to be getting the ordinary income and getting whacked with those taxes, it may not be worth it in the long run. So I'm just doing the math on that, but I'm waiting for my accountant to get back to me on that to see kind of where I fell. Plus the income I have coming in from the house and the rent, that's basically just income that I'm not getting taxed on. So I want to make sure I'm offsetting that with either, improvements to the house so I can write those off, or I'm putting money aside to pay the taxes, or I'm doing something constructive with that money instead of just, letting it sit and then losing it to, taxes. I could put that money into the stock market and let that go up as well. Historically you get 10%, whether we get it or not, I don't know. We got 24% last year and 20% the year before. So I could put it in the stock market, and if we get 10%, cool, that's better than even a high yield savings account. And then at that point, I would still have to pull money out to pay my taxes. And if the market goes up, then I take more capital gains for the following year. So a lot of different math things I've got to worry about and think about. So just wait for my accountant to get back to me on that. But I'm going to jump into the charts here now, and we'll take a look and see what is going on with Tesla. And sorry about that. I don't know why my computer is doing that now, but it is. It's super fun. All right, let's see here. All right, so looking at Tesla here, and again, we've got the gap up here to 394, and we did create another gap here at the 249.52. So as I was talking from the beginning of the year, we were seeming like we're on a dead cat bounce. Sure enough, we were. Then we were consolidating. I thought this consolidation was going to last until we got April 2nd, because that was going to be the tariff information. That was going to be the delivery news for Tesla. I thought we would consolidate until then, but we did pop up before that. Now, we do have these strong resistance levels here that we tested, and we broke above it one day, but basically broke down below it today at that $275 level. Or where's that? Yeah, 275. So that's kind of where we're at right now. And coming back down, I think we're going to come back down and fill this gap at 249.52. So looking at how we've been bouncing, I wanted to see us get above this level here at about that 250 mark. And sure enough, we did, but we created that gap. So now we have to come back down and fill that gap. So then the question is going to be, do we bounce off of it when we fill that gap and go back up? Or are we going to break down below it and continue back down and test these lower levels here? So looking at the lower levels, we're looking at, around that 221, 220 mark. If we hit those levels and break below it, then I'm going to be looking at the $200 level. But if we bounce off this and go up, I'll be paying attention to 300, because I did think we were going to be testing 300 at some point. And looking at this level here, right at 300, that was that resistance level that we bounced off of. So I want to see a second test of this and see if we can break it. So those are the areas that I'm looking at right now. We're right in the middle for RSI at 47.67. So we can basically go either way. And again, with the delivery numbers next week, the delivery numbers we're kind of expecting bad numbers. And we'll see what those numbers actually come in at. Because, if we're expecting bad and we get bad, then so be it. The market will probably be okay with it. But we also have to worry about the Trump tariff stuff that's going on April 2nd. So it's still a lot of uncertainties, waiting to see what's going to transpire. And then, of course, we've got, I think it's going to be April 23rd. We'll end up getting Tesla's earnings for Q1. And that'll tell us, what's going on with the Model Q ramp. Where are we at with that? Are we still on track for what's going on with FSD? We haven't heard a ton of news about things lately, or maybe I've been out of it because work has been so crazy and I haven't been paying attention. But there hasn't been a lot of stuff going on. We're just kind of putting one foot in front of the other. And realistically, when you're looking at yourself, whether it's finances, health and fitness, whatever it is, sometimes it's important to just put one foot in front of the other and stay consistent with your routine. And eventually you get to that point where, hey, I've been staying consistent with my routine. Now I feel, hey, I can push more, a little bit more. And then you push a little bit more. Then you make that kind of, step up, and then you kind of level off there. It's very much like you're looking at the stock charts and you're like, I'm kind of consolidating, and then, I can break out. And then I go up from there, and then I start moving up and I make some serious progress. And then I stop and I consolidate and maybe take a couple of steps back, and then you move forward again. So that's kind of how we're looking at it. What's going on, Alex? Not feeling optimistic about Q1 delivery numbers. Neither am I. I mean, the whole market isn't being optimistic about it. So at this point here, we knew going into this year that the automotive market as a whole was going to be challenged. So what we're looking at here is it's challenged. How much is it going to be challenged? How is Tesla faring against other automotive makers? Are they holding up well? We're looking at consumers. And so, of course, with interest rates staying higher, that was Tesla's challenge last year. Now, this year, we've got those interest rates staying higher again. And that took up a huge chunk off of their bottom line because they have to buy all of those financing deals. So they're buying these financing deals, taking a hit on the bottom line. And in return, they're not getting an extra push when it comes to automotive sales. They're basically just kind of treading water. They're paying for that to just keep it from falling further. We saw that last year where they saw the year-over-year numbers dipping slightly. It wasn't a lot, but definitely for a growth company, you don't want to see any dipping. You want to see growth. And Tesla had to pay to keep those numbers basically flat. They're in the process of doing the exact same thing this year. They're paying to keep those numbers flat. And that's kind of the concern that I see going here is, how bad are they doing? And if they're looking at, numbers that aren't doing as well as other companies, like if you're looking at, even ICE vehicles, Ford and GM, how are they doing? How is Toyota doing on a year over year basis or even a quarter one basis? If Tesla's not doing as well as them, that's a challenge. Consumers are being faced with a lot of debt that they're facing right now as well. Consumer credit is at the highest level it's ever been. So people and consumers don't have the money to spend. Tesla still being one of the higher priced vehicles that are out there, that's going to be a challenge. Even the Model Q coming out, let's say it comes out at 37.5, that's still going to be on the higher end. You can say, yes, it's lower than median prices or the average price of a vehicle, but that's still a lot higher than you can get, some of these cheaper vehicles at in that low $20,000 range. So Tesla would be facing competition there when people are like, I need a vehicle, but I don't have the money to get a Tesla, even if I want one. Even with the EV tax credits, it's still not helping me. I don't have the money to go and get it. I have to go and get myself a cheaper ICE vehicle or a used vehicle. They may look at used Teslas instead of getting a new one. So that's a lot of the challenges that we're facing right now. And I think that's going to plague Tesla all year long. Now, of course, long term, I still think we're going to be fine. We're going to get through this. We're going to weather the storm. Consumers are going to come out of this. You can look at it. I don't think it's going to get as bad as the great financial crisis, but it could be something similar. And if we get to that situation, we still came out of that. So we're going to come out of whatever we come out, whatever happens. But I think it's going to be a challenge in the near term. Actually, Alice, I don't even know. I haven't looked at numbers and deliveries. I've been so busy with everything else. I've really wanted to get back to take a looking at, updating my valuation model and all the deliveries. Just haven't had a chance to do it. So to me, it would just be literally blindfolded, taking a shot in the dark on a dartboard. So yeah, um, that Trump tariffs will not end on April 2nd. He will threaten them time and time again. Never been so pessimistic with the chaos going on. And that's really what it is. I mean, for him, Trump is using it as a way to leverage whatever he can from his perspective to do what he thinks is right, whether you believe that he's right or not, or what he's doing is good or bad. That's what he thinks is right, is doing that. And he uses it as leverage to kind of get that game and play the game to get what he's looking for. And so, he'll say, hey, I'm going to push you up. Now, India came out and said, we're going to cut a lot of our tariffs. Cool. So it's clearly working in some areas, but in other areas, it's not working and he has to play that game. And of course, him playing that game causes a lot of, turmoil and a lot of headlines that are out there, which then causes the market to go crazy all over the place. That's the problem that we're facing right now, especially as investors, because Trump says he doesn't care about what the stock market is doing, which means that he'll go out there and do whatever because he doesn't care. And that's the problem that we're going to be facing is we have a guy who is doing what he thinks is right from a larger picture perspective. So those of us who are investing are going to be facing those challenges with the market turbulence all along the way. And so that's why I put more money on the sideline for cash, just kind of waiting for that dust to settle. If there's an opportunity and the market gets pessimistic and sells off, I'll use it as an opportunity to buy more. If the market is cheering and bulling up, I'm just kind of storing the cash and waiting because we know, as we've seen, it can easily come right back down again. Exactly, Alex. Nothing the market hates more than uncertainty. And think about your own selves too. For me, for instance, like I had my plumbing issues. I had no idea how much it was going to cost. Like once I knew, I was like, all right, I knew I thought it was going to be bad. And then I got the number and I'm like, all right, it was basically what I thought it was going to be. But until I found out that number, I was like, oh, that's not good. I just didn't know. And that uncertainty kind of caused me some stress. Right now, I don't know what's going on with my taxes. Am I getting money back? Do I have to pay taxes for the first time ever? I don't know. So that uncertainty is causing me a little bit of stress. So that's kind of where I'm at. And, the market feels the same way. We all go through that. Somebody, that gets injured. You're like, oh, how bad is it? But you don't know until the doctor tells you how bad it is. So all of that uncertainty causes problems. And, that's just exactly what we're facing in the market. And we always get through it. Eventually we get to the certainty, but you have to be realistic. The market is always going to be facing uncertainty. There's always questions as to what's going on. Sometimes the questions aren't as pertinent. They're not as bad. So, that's typically when we're in a bull market, but even in a bull market, when we're going up and to the right, there's still a lot of ups and downs. That's all the uncertain times. And that's why you just kind of pay attention and say, hey, where in there is going to be an opportunity for me to buy, and where's an opportunity for me to hold, and where's an opportunity for me to sell if I want to sell. Sal, is a stock like Agree Realty a good prospect to park money in? I'm going to say yes. So the real estate um, market right now is kind of at a point where I'm expecting prices to come down, but it's weird because it's not like totally nationwide. There were some areas of the country that bubbled up over the last few years, and everything pushed up, but there were some areas that pushed up even more. They've since been coming down to kind of level off with everyone, but with the rates still being higher, the housing prices are still kind of staying the same. So you have to look at the supply and demand when it comes to all that. And if consumers don't have the money to buy, that means that demand is going to be down. And then supply is still going up because of builders, but not many builders are building out there because it's still higher interest rates. So they have to borrow a lot more money to make those builds happen. And so it's just a matter of playing that. And I'm not deep enough into the real estate market to know where all those numbers are at currently, but that's just kind of how it's fluctuating. So looking at how the Fed still does want to come down with interest rates over the next couple of years, chances are by late 2026, early 2027, we'll be around that 3% mark. That means that as the rates are going to come down, housing prices should be going back up. But the question is going to be, is the housing market going to come down before then? Now, Agree Realty is on the commercial side of things. So they're renting out to the places like Amazon, Lowe's, and other companies like that. I think it's really good. Agree Realty is very much like Realty Income. Realty Income, I own myself. I think they're going to be fine, but their tenants to me aren't as strong as the tenants in Agree Realty. Now, because of the fact that the tenants for Realty Income haven't been doing as well, that stock price has kind of stayed muted. Meanwhile, you've got Agree Realty has kind of pushed up a lot stronger than Realty Income over the last few years because of their tenants. So when you're looking at Agree Realty, they're both about the same. They both pay monthly dividends. I think Agree Realty does have better tenants. So if I was going to get in now, I would look for a buying opportunity in it, maybe dabble a little bit into it. I do think it's a good, I think it's a good prospect. Just the entire market as a whole, I wouldn't dump a ton of money into anything. You've got to know your own risk tolerance and what you want to do. I think they're going to be perfectly fine. I think they pay, the great dividends. It's great income coming in, but you have to remember when it comes to the income coming in that you are going to pay ordinary income taxes on that because REITs do not come with qualified dividends. So just keep that in mind when you're going to do that. You will get paid higher dividends, but typically REITs don't have the same equity growth as the QQQ or tech stocks, things like that. They're going to stay a little bit, flatter. They're going to grow, but not anywhere near as much. You kind of get paid out more on the dividend side of things. So as you're getting paid out on the dividend side of things, you pay more of those taxes now. So, and then if you do end up selling in the future, you have to pay more taxes on it as well. So just do the math on it for yourself and see where you're at, and figure that out. And as my dad says, he's in 4.3% short-term, state tax-free income with T-bills. T-bills are another great conservative way. To me, I just use SoFi. I get 3.8% on my high yield savings. And for me, I like that over the T-bills just because it's more liquid, so I can use the cash right now. Now, before I bought the house, I was rolling my money over in month-to-month CDs, which did work out great as well because rolling that over month to month, I staggered them, so I would always have money available if need be, or becoming readily available if need be. So I think that worked out well, and you can get more on that. It's there's a little more work into it because you got to play the timing of, when do I want to do this? How are the rates looking right now? And playing around with it. But just, take a look at those, especially if you're looking at, putting more money on the sidelines and holding it. I would not put it in just a regular savings account. You're going to lose money with inflation. So either a high yield savings, CDs, T-bills, things like that, are a good place to put it. And as my dad had explained to me previously, the difference between like a CD and a T-bill is T-bills, you're not going to be getting taxed on the state level, whereas CDs you will. So, and again, always do your research on it as to how it's going to work in your own personal states. But that's the differences there and different options for you guys or as to where you want to put your money. If you're in a place where you're unsure about what's going on with the economy, you don't know if the market's going to come down or go back up or not, and you kind of want to park some money on the sidelines, those are a few good options for you guys to look into is, SoFi, any high yield savings account, T-bills, CDs. If you guys are interested in SoFi for that, I have a link in my description. I get 75 bucks for it. You get 25 bucks for it. Just read the fine print in there. You got to put, I think it's like $75 in within the first like 60 days or something, whatever, 45 days. Yeah, I'm not sponsored by SoFi at all. They don't do that. But to me, that's a little kickback that I get there. But if it's something you guys are interested in, go ahead and check it out. Sal, rates for the T-bills, as my dad said, he's got 4.3%. But take a look, because there's a whole slew of options that are out there, different ranges of time that you can get, different percentages that you can get. So you've got to take a look at all the options that are out there for you. CDs you can typically look at any time, but T-bills you have to look at when the market is open. I have not found any place, at least not through Schwab where I'm through. I can't see the T-bills during off market hours. I had to wait for the market to open up to see what the rates were at. But CDs I was able to see in off market hours. So yeah, just again, different options that are out there for you guys for that. And then IRA is always great too, because if you're looking longer term, especially for something like the Agree Realty, you're not going to get taxed in an IRA. So you can put into a Roth IRA, you won't get hit with those taxes there. And then you don't have to worry about that. And what I like about it too is, and a lot of times people say, hey, dividends in there are great because you're not going to get taxed on it. And it is awesome. But think about growth stocks. Let's say you had, Nvidia 10 years ago and you had that in your regular account, and now all of a sudden you wanted to sell it. Maybe you're up, 10,000% on this stock, and you've got to sell it, and you've got to pay all of those capital gains taxes because you had it in your normal account. If you had that in your Roth IRA and you sold it out, you pay zero in taxes because it was in your Roth IRA. So just remember, while the dividends are awesome in your Roth IRA, it's good to have some good growth stocks in there as well, because when you do end up cashing those out in the future, you're going to have to pay no taxes on it. So it's 100% profit for you. Dad says mine are 3 month. I have 6 of them laddered every 2 weeks, so I'm never more than 2 weeks from my cash. Exactly, and that's what I did. I had staggered mine out about 1 to 2 weeks when I was rolling the monthly a couple of years ago. So that's a perfect strategy. So it's they may be tied up for 3 months, but you're not tying up your cash entirely for 3 months. You're just tying up a portion of your cash. You're always going to have that money rolling over and readily available within a reasonable time frame. So that's a brilliant strategy. Let me see here. I'm not going to be on for too long tonight, guys. I just because of everything with work that's been going on, I've been smoked, and I've got to call my plumber back because I've been playing phone tag with him to pay him, because I am not one to not pay my bills. Always pay your bills, and it's and little financial advice is do whatever you can to get yourself out of debt, especially high interest debt. If you've got like mortgage or lower interest, anything, for me, anything that is an interest rate that is lower than what the market returns are. And I'm not going to say like the last couple of years with 20 something percent, but average market returns. I'm going to go conservatively with 8%. If you have something alone with interest rate below 8%, then you can get away with paying minimum, maybe a little bit more than minimum, to kind of cut down on that loan over the long term. But thinking about paying the 8% or putting that money into the stock market and making 8%, it ends up being about a wash at that level. And of course, nobody knows what the market's going to do over the next year. But when you look at it long term, like a mortgage, when you're looking out 30 years and I'm paying 6.5%, I can make more money in the stock market. So just paying like an extra $100 a month on my mortgage is perfectly fine. I don't need to pay that loan down right away. But my windows, those are at about an 11% interest rate. So I want to pay those down faster because I'm losing money because I have more money getting paid out to interest there. So do the math on that. So then it comes down to, once you've got yourself to that point where you have no higher interest debt that's out there, you want to make sure that you're constantly paying those bills off regularly. You can play the game of, hey, I'm going to let it float until I get to my actual due date so I can take more money and leave it in the high yield savings or whatever. I was doing that for a little while. It's a lot of work. So to me, I was like, you know what? It's just easier if as soon as I, buy something or I have to spend money on something, I immediately pay my credit card off. I don't ever have to worry about getting to the point where, hey, maybe I missed it and I get tagged with the interest. I don't want to play that game. As soon as I buy something, I pay my credit card. Now, I do use a credit card because on SoFi, I get 2.2% back on all of my purchases. So I'm basically getting a 2.2% discount on everything I'm buying because I'm paying it off immediately. So getting that 2% discount is amazing. and then I pay it all off. Then I take all of the points that I get from that 2% at the end of the month, and I put that immediately into my investing account. So now I'm getting either high yield savings on it of 3.8%, or if I'm investing it, it's making me whatever money in those investments or dividends. So that's a kind of a little trick to be able to play with yourself is once you get down there, pay off your bills immediately, never have to worry about it. And now with the plumber, I'm not paying interest, but I don't want bills or anything out there floating out there. I want to know where my finances are at all times. I have a bill come in, I pay it immediately. And it kind of gives out good energy to the universe. That's at least I feel that way. I kind of view things that way. And you put out that good energy to the universe, and the universe is like, hey, he's good with his finances. It's almost like I think the universe is sort of like a bank. The universe says, hey, he's good with his finances. He's a good guy. He's paying that guy. Somebody came in and did work for him. He pays him back immediately. He's not letting that guy linger. That's good karma. We're going to, in return, give him things that are good. Just like I kind of felt it when my ex-wife called me up and she said, or she texted me and she's like, hey, we had overpaid for college. So as soon as I get the rebate in, I'll Venmo you half of the money. And I'm like, that was perfect because I just had the plumbing issue going on. So just that little bit of money coming back helped soften that blow. So it was almost like that little bit of karmic return coming back to me because of that. So to me, I like to do that because it puts out that good energy into the universe. Sal, explain SoFi. Rookie here. So SoFi is an online bank, so they don't have any physical locations. So it's all online banking, but they do a lot. So they have traditional savings and checking accounts. You're not going to get a checkbook, but you got your. Actually, I don't even know if you can get checks from them. But you can get a credit card through them. You'll get the debit card for the checking account, so you'll automatically get that, and then you can also get a credit card through them. They do lots of different types of loans, student loans, mortgages, refis, all of that stuff they do as well. Personal loans, they do a lot of that. And they have their investing. So you can invest in the stock market just like any regular brokerage. So you have all of that as well. And so it kind of combines all of your financial stuff all in one place. Now, when it comes to the savings side of things, they've got the regular traditional savings account. If you set up direct deposit on there, and I started it because I wasn't sure, I was kind of testing the waters with it. I started with $10 a week for my direct deposit. That $10 a week triggered the high yield interest. So you cannot get high yield savings with SoFi unless you're using direct deposit. And so again, I just tested with $10. So let's say you've got, and I was just working with a friend at work on this. Let's say you have, your main bank account that you're working with and you want to stay with them and that's good. And you have your direct deposit going into there, cool. But you want to get the high yield savings because maybe your regular bank isn't giving you high yield savings, but you want to get high yield savings on maybe a lump sum of money. For instance, my friend had a loan that came due. He spent a lot of it, but he had about $25,000 left over and wanted to get some high interest on it. So he put it in there and he just has a $10 a week direct deposit on it. That triggered the high yield savings for that $25,000, but he still has all the rest of his money going into his main account. That still works. So you can do it that way. I eventually ended up switching the majority of my direct deposit into SoFi because I love the vaults. My absolute favorite part of SoFi are the vaults. So for me, when I was getting myself out of debt, I would have money coming in and every paycheck, that money would get distributed to whatever debts that I had, credit card debts, car payments, all of that stuff would go all of that. Now I'm at the point where I recognized, I can kind of do that in reverse. So instead of like having my money divvied out to the debts that I have that money divvied out to future things that I want to pay for or buy. So right now I have money that goes into those vaults for the windows for my house. I have money that goes into the vault for my mortgage. So every single paycheck, I have money that goes into my mortgage, and I did the math on it. So at the end of the month, all of that money is my exact mortgage amount. That money then gets transferred into the regular savings and then automatically taken out to pay off my mortgage. It's totally, I set it all up at once, done. I never have to touch it. My mortgage gets paid every single month without me touching it, and all the money gets put aside for it. So I don't have to worry about, I spent too much money. Now I don't have money for my mortgage. I put my money aside for my mortgage before I have money for me. Done. All out there, all set. And then I have money putting aside for my emergency fund. Very important. Always put money aside for an emergency fund. So I have money gets put aside for that. I have money that gets put aside for a car because I know I'm going to need a new car soon, or at least fix the one that I have right now. So I have money getting put aside for that. So when I need a new car or I have an issue with my car, I've got money on the side for it already. I don't have to worry about where am I going to get this money from. I've been saving up all along. I have money that's getting put aside for car insurance. I pay usually because you get a discount on it. I pay my car insurance once for the entire year. So I saw last year it was like $1,200, which was ridiculous, but I don't want to get hit with that and have to pay $1,200. So I have money that gets put aside every single week for my car insurance. So when that bill comes due, I have the money. I don't have to scramble and find it. So that's kind of what I've been doing for a lot of things. I would like to buy real estate in the future, so I have money getting put aside for real estate in the future. So all of these vaults are all of my secret little pockets of area where I put my money before I get money for myself to spend, because this is all for future money. And the best part is about all of it, every single one of those vaults is getting high yield interest on them. So the mortgage that I have money getting put aside for at the end of the month, I'm getting paid interest on the money I put aside to pay my mortgage. It's phenomenal. And so, like even the money I'm putting aside for my son's college, I have money put aside for that. All of that gets high interest savings. So I love how they operate with that whole vault system, because to me, that money is just getting put aside for stuff that I want to spend money on in the future. And I'm getting high interest on all of that, which is just building up like a snowball effect, very much like dividends. So it snowballs into that. The more money I have in there, the more money I make on it. And then I just keep on adding more money to it. So I'm snowballing all of my vaults for future purchases. I'm snowballing my dividends. I just absolutely love how that system works. Sorry, I need a drink. And so, Sal, hopefully that answered your question on that. And again, I've actually one of the things that I do is I've been helping multiple people just get set up on SoFi. I should probably ask them for some kickbacks on this, but whatever. Again, that $75 that I get, $25 you get. It's a cool little bonus for doing all that. But I truly just want to help people say, hey, you can get yourself out of a stuck situation. Like I have a friend right now, my good friend. He's basically at break even. So, he's working on some financial things and he's got a couple things that he's not going to have to pay for anymore. So he'll have a little extra money to put into savings. And so I'm like, well, you can put it into regular savings, which is great, or you can put it into high yield savings, because then you're going to be making even more interest on it, which gives you just that little bit of extra money at the end of the month. And it's very beneficial because even like $5, $10 at the end of the month, like if you found $5 on the ground, would you just walk past it? No, you'd probably bend down and pick it up. You found $5. Cool. That's awesome. So that's kind of what it's like when you have the high yield savings account, is you're just kind of having money sitting on the ground at the end of every single month. So highly, highly recommend it. And Sal, I don't know where you're located. So if anybody here is international, I believe SoFi is just in the US, but yeah, I can't say enough good things about SoFi. They've been phenomenal. The credit card itself, again, it started at 1% and then randomly jumped up to 2% cash back for me. So anytime I spend money, I get 2% cash back. Super excited about all that. So like when I had to pay the plumber, the plumber was, a couple $1,000s. I threw that onto my credit card. Cool. I got 2% back on it. It was awesome. Let me see. I don't use SoFi, but I have accumulated shares of SoFi. I have too. Like I loved SoFi as a company, and then the more I used it, the more I loved it, and the way they run their financials, SoFi and the way they operate when it comes to fintech, that to me, I strongly believe is going to be the future of banking. And obviously, there's going to be some bigger legacy banks that will make that transition over. But that's what SoFi does. That is what their forte is right now. That's all they do. And so they're kind of going to end up being the leader there. And I have no doubt SoFi is going to be a multi-$100 billion company in the future. It's just going to be a matter of time. So, I've got shares under $8. That's my cost basis. I will be adding more to them absolutely in the near term. Absolutely love the company. Yeah, can't say enough about it. I'm just super thrilled with how they operate. Let me see. It's going to be just a couple more minutes, and then I'm going to jump off. As you guys can hear, my voice is already going, and I have a lot of sick people around me. I'd rather not get sick myself. So the more I can take care of myself, the better. Let me see. And actually, I'll take a quick look at SoFi's chart while we're talking about it. I know I've got them on here somewhere. Just give me a hot second to find it. There it is. Beautiful. All right. Oops, sorry about that. There we go. All right, so here's SoFi's chart. And, again, I follow gaps all the time. So SoFi does have some gaps. They've got a tiny little one down here to 751 for 1 penny, which sometimes people don't count that as one. A 4 cent one down here to 786. A little bit bigger one here at 907. And then the rest of their gaps are all above them. So we do have one here at 1291. So that 2 cent gap, which we almost filled today, that was created because kind of like the entire market with like Tesla jumped up. But and again, there's a gap above us, at 1786, another one at 1610. So kind of gaps all over the place for SoFi. And this 907 gap down here to me is very much like that 147 gap for Tesla. I think we get down and fill this gap if we get some really bad economic stuff that's going on and the whole market pulls down. I think that's how we'll fill that gap at 907. Otherwise, that may end up being an unfilled gap, and we go from there. So, filling this gap at 1291, I have no doubt we'll come down and fill that. I think we may fill the next couple of days. But yeah, so SoFi's charts is still looking strong. Again, their financials are phenomenal. They keep growing quarter over quarter. They grow their consumer base quarter over quarter. Looking at RSI here, it's kind of trending similar in sentiment to Tesla. Stocks like this, Palantir, are kind of in the same. It's a lot of the same investors that are in these, so that's why you typically see a lot of the similar patterns that go on with them. Like here's since let me see, December 17th was when Tesla was coming down. So SoFi did have that bounce when all the financial stocks went up, but now they've been kind of dead cat bouncing down as well. Now they've kind of reversed that trend, and SoFi is on an upward trend, and they just kind of bounced it here, but this may be just a little cooling off from the upward trend, and they may continue to go up again. I don't know. Again, what's going on with the whole economy is anybody's guess at this point. But to me, that's what I'm looking at when it comes to SoFi. Is I'm playing them very long term, very similar to Tesla. I'm looking at SoFi can easily do wild swings over the next 5 to 10 years. But I think those wild swings will be up and to the right over that long-term period. And I can easily see us in the next 10 years hitting 50, $100 in the stock price. And then, just kind of going up from there. So I think SoFi is going to be phenomenal in the long term, but could be great swing trading in the near term. So, but I'm going to jump off, guys. My voice is really starting to go. I'm getting some scratches, but thank you guys again for being on. Thank you for your patience. I will try to get back into that routine. I am working Saturday because we're back on the Saturday routine for work. So I'm working this Saturday. So that means I just got to scramble with my time and try to get a couple of videos put up for you guys Sunday and later next week. So I'll try to keep on doing the 2 a week and then the Wednesday night live streams. But thank you guys. Always love these conversations. Love having you on here. And I will see you guys later.